Hello, everybody. Michael Johnson here, and I am super excited for today's session. You know what? Lending is a big business in the commercial atmosphere, and I have one of the best in the business. I have Gina Koenen that's going to talk to us about multifamily. Now, she is just not your ordinary lender. She is what I would call a rock star in the commercial lending business. She's going to talk to us about some absolutely wonderful things when it comes to commercial financing. And she has a special gift for you. So I am super excited to have her on board with me. And Gina, welcome. Tell my students a little bit about yourself.
Hi, Michael. Thanks for inviting me on this morning. Yeah, my name is Gina Koenen. I'm a commercial loan officer with Provident Bank. I've been in lending for about 24 years and with Provident for a little over 18 years. When I first came into the industry, I was new to lending and wanted to really understand and not a strong math background myself. I mean, I can do math, but I struggled with really understanding amortization and payments and debt coverage ratio and all the parts, when you're young and coming into the industry. So at that point, I created an Excel spreadsheet to really help me understand. And as it turned out years later, I found myself using this tool and this methodology to help explain to new brokers coming into the industry, as well as single family brokers that wanted to cross over and cast a larger net so that, we can turn deals single family, commercial, and all of that has really taken a lot of life and helped me in my career because when you teach, you gain loyalty and friendship. And that has come a long way. And then the market constantly shifts. 5 years ago, rates were in the 3.5% range. Prior to that, another 5 years prior, they were in the 7% range. And then a decade before, when we had the last downturn, well, the downturn before now in 2009, 10, and 11, I mean, that was a whole different arena. Our rates were back then at 7 and 8, 7% for multifamily and 8% for commercial, which sounds really high, but here we are, a little over a decade, and we're right back where we were then. And the same struggles. LTV is more smoke and mirrors than it would be in a market where rates are lower. There's constant evolving and shifting. And as long as our brokers and our investors understand the market, we can be more empowered to understand how and why deals work and how and why they don't work on different occasions. And so that's why Michael and I are together and talking about this and hopefully sharing the knowledge to make it easier because, the biggest thing is when brokers bring deals and they don't understand why they don't work. And we all want to be empowered. We don't want to spend hours on a deal that's not going to make sense. We want to spend time on the deals that do make sense.
That is totally awesome. And I understand that you are a veteran, so I want to thank you for your service
Of
to our
course.
country. You're just an awesome lady. So
Thank
without further ado, everybody, I want you to take copious notes because Gina's going to bring the fire. She's going to drop the nuggets, and I'm just going to turn it over to you, Gina. So go ahead.
Okay, well, I'm going to share my slides. They're small slides, nothing major on them. I'll provide them to Michael in case people want them after. But really, this is a webinar I've been putting on for years, meat and potatoes. What I like to do is talk about what Provident does because that's the bank I represent. That's where I work. That's where my heart is. But the biggest thing that I want to share is it's not just Provident that we're talking about. Debt coverage ratio, investment cash flow, the way the numbers work, this is relevant no matter which bank you're working with. So you can take the seeds that we're talking about today and then understand what you can ask other lenders when you're trying to place a loan. Because the truth is, while other lenders tend to be in competition with each other, we each bring something special to the table. I refer to Chase Bank. Chase Bank refers to me, vice versa with like Axos Bank, with US Bank. We all have certain nuances, certain niches that we follow. And so that's why it's important to hear the seeds that we're talking about today. Keep them in your arsenal, use it for understanding, and then you'll know when you go to another investment lender what those numbers mean, if that makes sense. So just to kind of get started, some of the basics about Provident Bank. We are a large small bank in California. We've been around for, I believe we're going on 70 years here soon. We do have brick and mortar branches in Southern California, and we lend in the entire state of California. We're not a nationwide lender. Again, another nuance that's important to know because we're very strong in California, but if you're outside of California, you would want a bank that can work with you in other states. Providence loan sizes, we are more of a small balance lender, so we'll go as low as 300,000 on up to about 6 or 7 million. You'll find what I share here on the rate sheet or on my slide is that anything under 500,000, there is a rate bump. This is an important seed to write down because a lot of investment lenders actually won't even lend under 500,000. So this is something important to keep in mind. Those that do, you will find a small rate bump. With Provident, it's 25 basis points over our wholesale pricing. Loan to values, they matter. They're important in today's market where rates are 6.5%, 7%, some banks even 7.5%. We're not in the 3.5% range that we were 5 years ago. LTV is more smoke and mirrors today in this economic market than it was when rates are lower. And I'll get into that when we go over the worksheet shortly, but just keep that in mind because the property's gross rental income, the property's net rental income, that's what's helping lenders determine the loan amount that's supported. And that falls on debt coverage ratio, again, which we'll discuss. But it's important to know what lenders will go to on their LTVs. Provident Bank will go 70-75 on purchases, rate and term refinances. That's for multifamily. Office, we more are right around 65% in this market. And then cash out refinances a little lower. Sorry about that, a little lower on cash out, and that's just, higher risk. Seller carry, we do offer seller carrybacks. This market where rates are higher, I'm finding less and less seller carry is supported based on the numbers. But it's something in the arsenal. This is when someone's going to purchase the property and the seller's willing to carry some of the loan. But what happens is, it depends on the terms that the seller's willing to carry that money, and that's where it can kind of blow the whole seller carry out. So just keep in mind, this is a seed we're planting. Bring it to your lender, bring it to me or another lender and ask them about that if that's necessary, and we can help you run the numbers on that. We are what's considered an A pricing lender, and so we're looking for strong credit, strong borrowers, great properties. And that's why our FICO score is listed here at 680 and above. We will go a little lower depending on the story. Sometimes there's a medical issue in the past year or two that has made credit rough, but they've recovered, they're recovering. Sometimes, depending on the story, we can move forward with a little bit lower than 680. But we aren't the lender that's going to work with the guy that has excessive mortgage rates over the last 5 years in a BK. That would be more for your hybrid, your stated income lenders, where pricing might be higher. But there is a lender for every scenario out there. It just depends on, knowing who to call. Uh, I've got here on my list that we do allow credit for self-management. If you understand the apartment industry, some banks won't give a little credit back to the expenses if the owner's managing the property. It's something that we do. We'll add back 3% to the expenses or take 3% out of the expenses if we can see that the owner can and has experience managing the property. Providence rate sheets are located at this link, and Michael can provide that later if needed. These are the property types that we like. Multifamily all day long. I think my list, yeah, it is current. Okay, so multifamily, mobile home parks, we love mobile home parks. They're kind of scattered across California. You've got a bunch of beautiful parks in Palm Springs, Cathedral City. We've done quite a few in Venice Beach because there's a lot of those there. And then up in Northern California, there's some little pockets where there's some nice mobile home parks. What we're looking for is no park-owned units. The bank, everything that we lend on, we're looking at the what if. What if we get the property back? If it's a park-owned unit where the owner of the property also owns not just the land, but the mobile home itself, that's something that would be outside of our comfort because we just don't want to manage mobile home units. We like the mobile home parks where people pay space rent and they own the unit themselves. And we just don't like RV. We do want all the units skirted. Most of them should be double wide. Kind of your 4-star, 5-star mobile home park would be what fits in our arsenal. And the numbers that we're going to calculate here shortly, that is the same as multifamily. We're going to take the gross rental income minus the expenses, vacancy factor, come up with the net operating income, and then use that number to determine the supported loan amount. We do like small non-anchored retail. Restaurants are outside of our comfort, but everything else, cafes, um, your bakery shop, your insurance office, your salons, barbershops, things like that. We love small mom and pop business retail, self-storage and office. I have this on my slide about difficult properties under other lender sources. When you're calling around and you're trying to place like an auto repair or a car wash or gas station, even restaurants, those tend to be single use properties. They are, if you think about a gas station, it's not easily converted to be an office building. It is a single use. And when you're calling around, you'll find that a lot of the A pricing lenders, the lenders that, have the better pricing in the market, they're not going to be as comfortable with your single use properties. So as you call around, keep in your phone book and your workbook or how you're keeping track, who are your hybrid lenders? Who are your stated income? Who are your private money lenders that don't mind the single use properties? And those are things you want to watch for. And these are properties that Provident Bank isn't comfortable with. And I say that lightly because we have done some car washes and we have done some restaurants. And I know we've got a couple gas stations on the book, but they really need to be low loan to value and really nice, strong looking properties with a strong borrower for us to kind of jump in the game on those. Okay, when you're working with a lender, it's important to know what a lender is going to ask you for in order to help you get a quote, understand terms. If you're sending an email to a lender and you're just saying, I've got a 6-unit property and I need 80% loan to value, the lender's always going to come back to you and say, I can't I can't even give you a general. What are the 6 units? Is it multifamily? Is it mixed use? Is it restaurant? What are those units? If it's multifamily, there is kind of a rule of thumb where we can back into a general idea of expenses. If it's mixed use, maybe you've got a hair salon and an insurance office and 2 residential units. That's different because the expenses for apartments are typically, mixed between the tenant pays electricity and the property owner is paying their taxes and their insurance and other property maintenance. When it comes to office or retail, sometimes it's either triple net lease, which means that the tenants are paying all the expenses. Sometimes it's a modified gross lease where maybe the tenants are paying some of the expenses and the property owner is paying some of the expenses, or a complete gross where the property owner pays everything. And any lender that pretends to know what those expenses are, they're kind of making it harder for you to get to that bottom line before you spend your borrower's money on the appraisal. So the best thing to do in that scenario, if it's a purchase, ask the seller, give me 2 years income and expenses so I can show the bank what the expenses are for the property so we can come up with at least a tangible close loan amount before your borrower gets in the game and wants to start, ordering the appraisal and moving forward. So that's why it's important to really understand this list. We need the address. We've got Google Maps now. We don't have to go drive properties. I can pull it up and see if it's, if they're using chickens for pest control and it's out in the middle of nowhere and it's a farm, or if it's a really nice apartment building or a nice clean mixed use building, we can see what it looks like. We need to know the unit mix, what everything is. Are they apartments? Are they office? If it's apartments, are they 2-bedroom, 1-bedroom, things like that. So these are, just important hints for you guys to keep in mind when you're working with a lender. We're going to talk just a little bit here and we'll go into the worksheet in a few moments, but here's some basics on loan to value and debt coverage ratio. And I kind of hinted to this already, but the rental income the property generates will determine the property's value. And that's what a bank calls our income value. And if you've seen a commercial appraisal, they're going to tell you the sales value, they're going to tell you the market value, and then they're also going to tell you the income value. The sales value is typically what people agree to pay for the property, right? The seller lists his property for 5 million. Somebody comes in and makes an offer at 4.8 and everybody agrees to move forward. That's kind of what that property's worth, what buyer and seller are willing to pay and exchange the property for. That property value, that sales value is often significantly, especially in today's market where rates are higher, it's significantly different than the income value of the property. The income value of the property is based on the property's net operating income and then using the market cap rate to determine, kind of where that's going to fall. And that's where I discuss that here. Our net operating income divided by the market cap rate is our income value. Cap rate is a moving target, and I get asked this a lot in class. How do I calculate cap rate? I'm not an appraiser. I am not one that has all of the data and all of the schooling that appraisers have. It's not just the data that they have, but each economic market has its own level of risk. So your capitalization rate is the level of risk and return that is achievable on that property. Sometimes a high cap rate says there's room to increase rents to bring the cap rate down and make it valuable, and increasing the rents gives more value to the property, right? It means we have more profit over our expenses. Um, I always would lean on an appraiser. If you have an appraiser in your Rolodex, your contact base, you could call them up and say, look, I've got an 8 unit in Anaheim. Do you have an idea of where cap rates are? Lenders will get, I see appraisals on a weekly basis. So I have a good feel for most cities in California because that's where I lend, because I'm seeing appraisals often. As a lender, our bank also subscribes to CoStar. So often I can look up in CoStar and see what cap rates are. But, as a general rule in today's market, in most major metro areas of California, cap rates are falling right around 5%. At the beach, it's probably, your Laguna Hills areas, your Marin County up in Northern California, where, vacancy is at an all-time low and it kind of stays at an all-time low. You're probably looking at a 3% cap rate. But then you look at a property out in Chico, California, or Barstow or Victorville on the outskirts, and you're probably looking at a 7 or an 8 cap rate. Because those areas tend to be more, they respond more depending on the job market and who's moving in and who's moving out. During COVID, a lot of people moved out to Bakersfield and Victorville areas because it was cheaper and they could work remote. But now that companies are bringing people back into the brick and mortar, now they want to be closer, so their commute is less, and they're coming back into, your Orange County and your LA areas. So lots of moving targets, things that you don't have to remember, things that you always can lean on your lender for. But I like to plant the seeds. And before we move forward into the actual worksheet, just some numbers to help you see. Most lenders out there, and my worksheet is slightly outdated, but only for Provident. Most lenders out there are going to require anywhere from a 1.15 to a 1.25 debt coverage ratio for multifamily. The debt coverage ratio, the lower it is, the more dollars you're getting. The higher it is, the less dollars you're getting, essentially, is a good way to look at it. Provident is 1.20, so my worksheet is a little outdated for multifamily, and we are currently 1.25 for office and retail. And all that says, the debt coverage ratio in the commercial arena is your property's net operating income. A 1.2 debt coverage ratio states that my net operating income on the property has to be 20% higher than the annual mortgage payments on the property. So as you can see today, our rates, the whole industry, we're all in the high sixes right now, 6.7 to 7.1, depending on which lender and what kind of property. If you compare that to 2020's rates of 3.5, our mortgage payments are significantly, they're more than double what they were 5 years ago. So if my property has to have a 20% profit over my annual mortgage payments, in a world where rates are 3.5%, I'm going to get far more loan dollars than I am in a world where rates are in the almost 7%. So, and that's important to understand about debt coverage ratio. And then I'll show a little worksheet on how to get there quickly, because I don't love math, but I love Excel. And if it can get me there fast, then that's great. Um, Before we get into the worksheet, just something else to keep in mind. Most A pricing lenders like Provident Bank, US Bank, Chase Bank, who else is out there? I think Wells Fargo is kind of out of the market. We've got Malaga Bank, Intervest, all your big players that are my kind of direct competition. We're all full documentation lenders. If you're wanting to go stated income, more on bank statements and things like that, you're looking at higher pricing, right? Every nuance that you take out of a perfect deal brings you into a different echelon. So if your borrower strong, credit strong, property strong, then you're going to get, the A pricing lenders. If your borrower is a small business owner and is trying to juggle tax liabilities and doesn't really want to report so much, then his personal cash flow may not be as strong. He may need to go stated. That's where you would work with more of a hybrid type lender with a little bit higher rates and fees, et cetera. With us, with the banks like us, we are looking now in this world, and I see in my notes, I reference the economic downturn of 2010. Prior to 2010, we actually didn't care as much about the borrower financials, because if the property was strong, the theory was, well, that's what we get back if the borrower goes in default. And that's what banks were doing. We weren't paying as much attention to the borrowers. We were paying attention to the property. But then this whole downturn happened in 2009, 10. I'm sure most of you that have been in the industry a bit remember thousands of banks shut down. I mean, we were all watching Bank Watch daily. Like that would be what I would log into every day and see which banks shut today. I mean, it was just insanity. After that, the regulations in the market have completely changed, and most of your A pricing lenders are going to be full doc. We're going to look at the property to cash flow itself, and then we're going to look at the borrower to make sure they can put food on the table, pay their bills based on what they tell Uncle Sam they make. So now it's dual. It's both sides if you're working with your A pricing lender. If your borrower is not going to be strong on their personal, and comparatively to the residential world, what most banks are looking for is similar to a 40 DTI or better on the personal side. The property cash flows itself, but we need to make sure the borrower doesn't have to pull on all the profit and then some from the property just to put food on the table and pay their car payments and their mortgage and all of that. So that hopefully makes sense there. Most lenders are going to look for 12 months principal and interest on subject property in reserves, along with down payment if it's a purchase. We already talked about credit, so I think we kind of covered that. I am going to switch over to, let's see if I can get this to share. Let me change screens. Okay, so we are ready for the worksheet now. And let me get this large. So I created this, like I said, probably, I don't know, 17, 18, 19 years ago to help myself. And then I've revamped it a few times. It's nothing complicated. It is one of the most simple Excel sheets, and Michael will have instructions on how to share this with others. The top half, I basically just designed this so my brokers can print this out and share it with their borrowers back in the day when we had to print more than we can share online, right? So it's all self-explanatory information. The most important parts of this worksheet is this whole bottom section. And it auto-calculates. It takes a lot of the calculations out and just allows you to see on quick glance. The one thing you'll want to check with me with is, what are today's rates? What are today's cap rates? Those things are important. My worksheet defaults to 5. A good number of properties in core employment areas in California right now are right around 5% for cap rate. So I'll change that. Our rates today for multifamily are 6.8. So these are two numbers I'll just adjust before we even get started. And then what we'll do is we'll say let's say we've got I don't know, a 6-unit property that brings in 9,000 a month, right? All you do is enter your gross. Actually, before I start showing you what happens next, let me take you through what the worksheet's going to do. So we just enter our gross monthly rental income. These gray fields, you can type in them, it'll change the formulas, but the gray field will auto calculate by 12 months. It'll auto throw in 35% for expenses. That's a default for multifamily. It does not apply for mixed use, for office, for industrial. We talked about that. We have to see either the borrower Schedule E if it's a refinance, or 8825. This is in their taxes where they report the income and expenses. We have to see what they're reporting, and that's the number we would throw in here. But for apartments, as a general rule of thumb, and actually 35% might be a bit light, but it's a starting point. 35% of gross rents, a rule of thumb, encompasses our property taxes, our insurance, our landscaping, anything that falls through to the owner on, let's call it a 7 or 8 or even 15-unit property. Pretty generic. With the insurance increases on property insurance in the last couple of years, in fact, we just had a lender forum yesterday where an insurance agent was saying that some insurance quotes are running about $800 a door right now. So these are variables we don't know when we're quoting and trying to pull the deal off the street, as we say, get the borrower to move forward with us. We're trying to show them what the appraisal is going to come in at. We're also trying to show them how they can get the dollars they need and keep everybody happy on both sides, right? So if an owner's expenses, they're doing everything themselves and they're running 20% expenses on their Schedule E, it should be 35% or 35,000 at market, and the borrower is claiming 20,000 in expenses. You want to keep in mind the appraisal is going to show us what market is. So if the borrower's expenses are far lower than 35%, I use that as a teaching point. I explained to the borrower, I explained to the broker, I understand your expenses are lower than market. I could possibly get you these loan dollars if the appraisal supports 20% expenses. The likelihood of that is slim, very slim. So then now we're going in with eyes open. If the appraisal happens to support 20,000 for expenses for your 6-unit property, then you can get this loan amount. If it comes in higher, like 35, even 38% for some of the older properties in LA or surrounding areas, our loan amount's going to shrink. Important to explain to your borrower. If we all go in transparent, then everybody's happy and we're educated. So that's what this top set of boxes is going to get us our net operating income. A second set of boxes, when rates are low, this applies. This helps us see, if we're in a world where rates are at 3%, LTV matters. Right now, it really doesn't, but it's still going to tell you the income value of the property the net operating income divided by the cap rate, which is the income value of the property. And then it'll default to 75% of that value. So now, and then the bottom set of boxes is allowing us to change our requested loan amount, our interest rate, our amortization, and the last box is going to tell us our debt cover based on our rental income. So again, if we were going to take, let's just assume 9,000 a month, I enter that, I hit tab, my worksheet's going to auto calculate everything we've talked about. So we've got, and 90,000 is not what I was targeting. Okay, that's better. So we've got 9,000 a month, 108,000 a year. Default on expenses is 37,800. I'll double check the borrower's Schedule E and make sure their number is not higher than that. If their number is higher, this property costs more to maintain. Their insurance is higher, their taxes are higher. Double check that if you can. If you can't, then the only choice is for all of us to wait till the appraisal comes in. Most lenders are going to put in a default vacancy factor of 5% for multifamily, 10% for commercial. I have 15% in there because some lenders will use 15% vacancy for a single unit property, single tenant property. Sorry about that. If we have just a standalone Starbucks or something like that, the vacancy factor might be higher. So that gives you the option. But standard 5% for apartments. Here's what we talked about. So based on this property's net operating income of 64,800, divided by a cap rate of 5%, this property has an income value of 1.296. In this market, it is not uncommon that I'm seeing the list price for a property like this at 1.7, 2 million, especially in Santa Monica or Manhattan Beach. I had one the other day that came in for Manhattan Beach. The property is selling for, I think it was 3.2 million, and the rents were very similar to this. And unfortunately, the only thing the borrower can do, there's land value in Manhattan Beach, beautiful place to live, beautiful city, definitely has the land value, but the owner that was selling the property hadn't raised the rents in about 10 years. So well below market. Unfortunately, until market rents are in place, they're smoke and mirrors. They're a hypothetical scenario based on what we could get after we evict all of the tenants that are in the building, because most likely if your tenants are paying 900 a month for the last 10 years, they're not going to just say, sure, just charge me 1700 a month now. You have to go through a big process of changing those rents. And so when you're wondering why banks don't use market on the investment side, it's just not that simple. If there's a vacant unit and we can get that leased at market, that's different. But, with California rent control and 3% increases annually, you can't change the rents. So market rent is really difficult to use. So again, sorry, I followed a little rabbit there, but it wouldn't be uncommon in Santa Monica, Manhattan Beach, Laguna Beach for this property to be selling for 2.5 million, 3 million. And because of the rents in place, this is the value that it has. So based on the income value, a 75% loan to value, we're looking at a loan amount of 972. This feeds down here and we're super happy. We're thinking we can get this loan amount. Maybe this property's priced at 1.3 and everybody's happy. We come down here with the rate of 6.8, amortization of 30, and we look at our debt cover and uh-oh, we have a problem. Now, based on 9,000 a month, in a world where if rates were lower, because here we go, watch, if I put in 3%, we have no problem. We can go 75% all day long, or 3.2, which I think was a pretty solid rate during COVID, during 2020, I think even bleeding into 2021. No problems all day long. Then I care about debt cover, or I care about loan to value, and debt cover ratio doesn't even come into play. But today's rates, we're back at 6.8. I have no choice. I have to reduce my loan amount until this debt coverage ratio equals 1.2, which again is profit over annual mortgage payments. And if you look at our net operating income, we're at 64,800 NOI. Our annual mortgage payments are 76,000. This property costs money to own at this loan amount. So let's just start playing with our loan amount. Let's drop it 100,000 and see what happens. Well, that doesn't even bring us break even. I think we're going to end up right around, nope, I went too high. Let's see what 7 does. Okay, so we're about 675 gets us, 685 gets us to close to 1.2. So that should help you guys see how the market matters, how LTV in today's market is more of smoke and mirrors because of where the rates are. When we were back at the 3%, we had no problem getting 75% loan to value. But in this market where rates are, when you lead with, or your borrower leads with, can I get 25% down on an apartment building? You don't have to remember everything I talked about, but it is important that you understand that why the LTV doesn't work with 25% down. We have to know what the rents in place are. We have to know what those numbers are in order to help your borrower be educated before they enter escrow. And I adore all the people that are in my industry, all the commercial lenders that I rub shoulders with at our commercial conventions, but I'm one of the few that loves to teach single family brokers, to where a lot of them really prefer working with commercial brokers because, we can talk the talk and get to the end of the day faster. And it does take a lot more work working with people that don't understand commercial lending. But because they're so used to their acronyms and the way things work, they won't take the time to explain when they say, I can do a maximum of 75% loan to value and a minimum of 1.2 debt cover. the assumption is that most brokers know what 1.2 debt cover means. So if we're asking for a loan amount of 950 and they've told you, well, yeah, okay, as long as that's supported at appraisal at a 1.2 debt cover and 75% loan to value, we're good. And so you and your borrower package up the deal, you bring it forward with the bank, you get excited, you move forward. Appraisal comes in, and lo and behold, we can't get 950. We can only get, whoops, our 675, right? So that's why education helps everybody be on the same page moving forward. That's not a big deal, but it's bugging me that my numbers aren't there. So there we go, Michael. That was a long breathful, but kind of the nuts and bolts of what I had to share and what I wanted to kind of help spread the word on.
You know what? Excuse me, that was awesome. It was excellent. I took a lot of notes myself. It's helping me to really understand, and I want my students to understand this. 75% is the maximum. The
Right.
two magic numbers is loan to value and DCR. The
Yes.
real magic number is DCR. So
In
before,
this market, yes.
correct. And I believe in any market because the DCR, the lender is going to want you to hit that number or it's going to be no deal.
Yeah.
Of course I know.
Yes. Spot on.
So I hope you took copious notes. Gina, did you put your information on there? You want to bring your information back up so that they can take it down? If not, please contact me and I will pass it on.
Yes, I've got, hold on, I don't really have something but on the worksheet, Michael, I'll make sure you know how to access it.
Okay. All right.
But my
Absolutely.
information is on the bottom of the worksheet, and it is on a personal website only because Provident has no idea where to put my worksheet on their website. So I have a small website that I just use for my worksheet. And when you get the link to it, what I do is I collect the name and the company name and the email. Once they enter that, they'll get the direct link to the worksheet. So and
Perfect.
we can
Perfect.
talk after the call if you want it accessible differently.
Absolutely. And plus my students, they'll reach out to me. I'll make sure that I get them over to you. This has
Sure.
been a fabulous training. Thank you so much for joining the show. And we're going to have you back. We're going to kind of break down some of that information that you talked about and have you back. But thank you so much for joining me. You've been awesome. Stick around. I like to chat with you after the recording. But hey, everybody, hope you took copious notes. The name of my course is Going from Residential to Commercial. Gina is a lady after my own heart. We're both educators. We both want you to understand the basics so you can be successful in commercial real estate. So I look forward to talking to you soon and have a good life. Talk to you soon. Bye-bye.
Thank you.